Hi everyone. So today's lecture is about debating finance motions, and I think I went a little overboard. I expect this to be a bit long, but before I start, I want to mention a couple things. Number one is that this is not reflective of my personal views or the views of any organization or company that I am a part of. I tried to keep everything very factual and useful in the context of debating. If I feel like something is maybe not as clear cut, not as well established, like literature, for example, I'll try my best to flag it. Second is that this is in the context of debating, and I think what that entails is there are times when the debate world is a bit different from the actual world. I think a big part of finance is its relationship with numbers and how much numbers determine decisions, realities, etc. Whereas I think debating is not very conducive to numbers. I think, and it's understandable, right? It's very difficult to somehow explain a spreadsheet, for example, to someone and say that that's your argument. But I do think there are things that, when you get down to numbers, might be bigger or smaller problems in the debate world than they are in the real world. Or I do think sometimes there are ways that you can theoretically or logically prove something that might not really add up in real life. Um, and I think that's a pretty important distinction between the two. So here's a general outline. I just want to divide this into halves. The first half, I think, is trying to really simplify finance and look at it from an overview rather than approaching a finance motion by looking at the pros and cons of every individual thing. Because while I think it can teach you about the greater world of finance, I do think it's hard because once you encounter a motion you haven't encountered before, you might be a bit lost. And the latter half is mostly like spec stuff about how financial markets work, for example. I want to like mention two pretty important people. The first is Bobby, who I'm not going to pretend I knew particularly well. I have spoken to them at times in the past and asked for feedback when they've judged me. Um, but you can see the impact they've had on the Asian circuit and especially in the Indonesian circuit. I want to ensure that their memory is kept, as this lecture series, which was originally in memory of Bobby, continues on. I'm really glad that the AdCore has kept up with this. I think this is going to be a very useful resource for debating in the future, and seeing some of like the most established debaters in Asia contribute the other lectures I've seen so far is it's really nice. I hope we all remember Bobby. Second is Ryan, who I didn't know very well at all, but I have seen the legacy they've left in debating, not just in winning, but I think very importantly, debate education. I mentioned this because Ryan has a very, I would say, comprehensive lecture on finance. And rather than try and just regurgitate or repeat some of that information and less eloquently or specifically than Ryan explains it, my goal for this lecture is to really be kind of complementary. I think Ryan's approach is very inductive in nature, meaning I think there's a move from specificity to generality throughout the lecture. And I kind of want to do the opposite. I want to start from general and overview and start from basic principles and then apply it in specific cases. And hopefully you are able to combine the two lectures and ensure that you have a very holistic view of finance. I have watched most of it at the very least, and I am hoping to really complement the understanding you can gain from that. And I highly recommend, after watching this, if you have time, since I think both lectures are going to end up being fairly long, checking Ryan's lecture out. May both of them rest in peace. All right, I want to start with the mindset around finance. I think there are three mental hurdles for a lot of people to understand financial debates. Number one is just thinking that it's difficult to understand. A lot of people will see a long info slide about a financial instrument and be like, oh, I'm too stupid for this. When I think most of the time that's really not the case, especially if you can do debate and it's all handling this dynamic exchange of logic. I'm pretty sure you can do finance. Second is it requires so much knowledge, right? So maybe you can follow like individual info sites, you can follow individual motions, but then the moment a new one comes up, it's difficult for you to have to do that all over again. Third is that finance is only really useful for finance. So why invest the initial effort when it's not going to come up anywhere else? So on finance being difficult to understand, I think when people see a finance motion and think, I don't get it, this is so hard. A lot of the time that's indicative of the fact that they don't understand something that's a bit more fundamental. And it'll be very difficult for you to understand the complicated thing if you don't understand yet the simple things. And so a lot of finance is having the right mindset and approach, and also just having the humility to accept there are more basic financial concepts I don't think I have the best grasp of. And if am able to understand them first, then the more complicated stuff comes after. So, for example, if I get a motion on a collateralized debt obligation, I would think that's pretty confusing. But if you just read an info slide on it and think, I don't get it, you might have to understand the more simple terms in the motion, like mortgages and securitization. Is securitization a very simple thing? I don't think so. And so you probably have to try and understand that first. And then it goes deeper and deeper and deeper and deeper. And I think this kind of approach is very helpful because at some point you're going to reach something you know and work your way from there. I feel like that's a much healthier way to approach finance because it also allows you to learn fundamentals rather than just learning the most specialized version all the time. Second is it requires so much knowledge. Um, and like I mentioned, you can't just Google something and look at the pros and cons of it and think, oh, well, I need to do this for every finance motion that I see. Specialized information helps for sure, right? Like different financial instruments, institutions have their particularities. But if you understand finance from principles, you can logic out what might be the pros and cons of any motion. And I feel like that's a much more useful approach because you will inevitably encounter a debate of something you don't fully know or understand. And I'd say that's quite helpful because debate also, it changes, it adapts to new trends. Like I'll talk about this a bit more later, but during like the peak of my like activity in debating around 2021, 2022, I'd say crypto was a huge debating topic, and I don't think it is nearly to the same degree now. And you're moving towards like, private equity motions, for example. And so, if you were studying so much crypto at the time, it's very difficult now because what would you have done with all that effort? Whereas if you were studying a more general and holistic approach, there are some principles from the time that you studied finance then that will definitely still translate to the present. Last thing is that finance is only useful for finance. I think finance has a lot of crossover. So motions on big tech, I think you can argue about the stock of big tech companies. Big tech is one of the biggest chunks of the S&P 500, which tracks like the biggest companies within the US. Sports teams are financial ventures, and they use a lot of concepts similar to financial markets. So like trading players, getting first and second round picks in the NBA, salary caps, etc., are all things that, if you understand financial principles, can also be very helpful in making arguments in relation to sport. And finance doesn't just exist in the financial world, right? Housing, health, and I would say particularly business are different motion types that are definitely influenced by finance. I'm not saying you should go into any kind of round, like you enter a round about a religion and then you say, I have arguments about the stock market. But I would say that this is a system that is highly interconnected to all other industries and is based on maximizing value for a lot of people, based on creating reasonable incentives for different groups of people that I think will very easily translate to many other systems that try and do the same. So I want to ask, why does the financial system exist? Because I think it's very easy from the outside looking in to think this is just a system that makes rich people richer. This is, not a valuable thing, right? Like, why would I care about buying stocks? when there are companies that feed people, when there are companies that make medicines, when there are companies that make new technologies, and then these guys are just buying stocks or something. So why does this whole thing exist? Let's start with a very simple situation. You have someone who is a spender, meaning they need money now, but they don't have the capital now, but they believe they can raise it at some point in the future. So, for example, I'm a car buyer and I don't have enough money to buy a car instantly, but I can give you maybe regular payments of smaller amounts. But give me time. That's the important bit. I can't pay all of it now, but I can kind of stagger and divide those payments into smaller payments in the future. That's true for someone who wants to buy a house as well. Or especially if I want to start a new business, I might need a loan. And when that business makes money, I can use the proceeds from my business to pay off the loan. And then you have a saver. So someone who has excess short-term capital, right? Maybe this is someone who is making more than they need for their monthly expenses. And so they are able to save up a bit of it. And you want to also not just keep it somewhere, you want to make it grow. So you want to make sure your money is making money. So this is, for example, people with a savings account. And it's usually quite small, so I think not a lot of people are aware of this fact, but if you put your money in a bank, they do have a small interest rate to make sure that you keep your money there. So they'll add to your money. Usually, the use of a bank and the ability to make transactions on it and stuff is enough for most people to keep their money there. But anyway, this is just someone who can save money, right? These two can have a sensible transaction. One has too much money and doesn't need it now. The other one needs money and needs it now. And the person who wants to grow their money can maybe tell the person who needs the money, can you pay me more than the amount that I lent you? And it can become a mutually beneficial transaction as a consequence. So one option is they can just directly transact, right? So the saver gives their immediate capital to the spender, and then in the future, there is a gain that is transferred to the saver. And this makes a lot of sense, right? But then some questions come in when you actually do this. Number one, very simply, how do you find this person? This is not an easy thing to do. A lot of the time, there are differences, especially if the people all around you are savers or if the people all around you are spenders. It can be a tricky thing to do. Second is, how do you negotiate the price? So the person with excess capital wants a return on their investment. How do you know that they won't use the fact that you need money against you and say, I will demand a very, very high future amount? Thirdly is, how do you manage risk? Especially on the side of the saver who is lending out money. What if that person just never pays you back, right? So maybe it sounds good in theory, but what trust do you have? Even in the worst case, you send a legal team against them, you try to collect the money. What if they run away somehow? That's not the best situation to be in, especially just the anxiety, right, of not knowing if you'll be paid back. Lastly, what if the terms are not mutual? So let's say, for example, I am a spender and I need $1,000,000. And then the saver has savings, but the savings is like $50,000. Then you can't have a transaction, right? They're not just gonna say, okay, the 50,000 is enough. I will still buy a home. I will still buy a car. No. If that was less than what they had wanted, then this is not going to be a transaction that works out. So the second option is to have a financial intermediary. So the saver will give their immediate capital plus some cut to the financial intermediary. And then the financial intermediary will give the immediate capital to the spender. In return, the future gains plus some cut goes to the financial intermediary, and then they transfer that to the saver. The cut here, I think it depends, right? Sometimes you will not ask for a cut from the saver. In fact, you might incentivize them to give them the cut instead to keep their money with you. There are other times where you'll take the cut. So for example, if I put my money in a bank, they might give me a cut. They might tell me I will have interest on your savings so that you are encouraged to put your money with us. However, if I put that money in the investment part of that bank and they use it to invest in something, they might charge me a fee. So that's the cut that they gain. So the long story short is this kind of depends, but generally the financial intermediary answers and makes easier a lot of the previous questions. But they need to benefit somehow, and obviously they need to keep the lights on and keep running. They're gonna need a cut, usually and mostly from the spender, but at times from the saver. I think you can simplify a lot of financial transactions in this way. So for example, I am an account holder. I will put my savings in a commercial bank. That commercial bank will hand out a loan to a mortgage borrower. That mortgage borrower will pay like regular payments of the loan to the commercial bank, and then the commercial bank will pay me back an interest on my savings. And so this is, I would say, the classic financial transaction. You also have an investor putting their investment in an investment bank. That investment bank buys stock of a company, and then the company, when they make money, they will return some of those gains, or in the form of dividends, or if the investment bank sells the stock that they own, they'll get capital gains. It goes to the investment bank, and then a portion of the capital gains or dividends will go back to the investor. So is finance just glorified middlemen? Like, are these people really making so much money just by being in the middle of all these transactions? Kind of, but not really. There are a lot of reasons you do want to have intermediaries and not directly transact. Number one, and I'd say very importantly, is the assumption of risk. In most cases, not all, but in most cases, a financial institution can protect its investors from individualized risks. What does it mean? If I'm a bank, let's say some people don't pay their loans back. And that's usually the case, right? Banks will encounter some defaults. It is also not usually the case that depositors or people who keep their money in the bank will lose all of their money. Or the bank will say, sorry, we face some defaults. We're going to have to take part of your savings. Obviously, there are cases where if the bank really goes under and runs out of business, then you won't get your money back, or you will get only the insured part of it back. But most of it, the bank assumes as risk because they can profit, right? Their profits allow them to assume that risk. Compare that to if I had individually decided to engage in a transaction with someone and lent them money. If that person did not pay me back, then I just assumed all the risk, right? Like, I get none of my money back. Second is expertise. So I think it's important to note that not all participants in the financial sector are financial experts, right? If I'm a company who is seeking investment, my field of expertise, let's say I'm a restaurant, my field of expertise is food, is generally the food and beverage industry. Not necessarily like financial ratios, not necessarily capital markets. And so having an advisor explain to me how all this works, what I should expect, what is the value of my company, because it's often not an easy question to answer, can provide domain knowledge. Importantly, right, there is, this interacts with the assumption of risk, because people might not necessarily fully understand the risks that they get themselves into, and so having someone advise you on them can also be very helpful. Another important thing is it's not just in finance, but even outside of finance. So in a lot of private equity motions, I think a big topic will be how much they're able to teach a company that they have acquired about the industry itself. So maybe there's a family-owned, let's go back to the restaurant example, restaurant business, that for years they've run the restaurant the same way. But they don't realize that the industry has a lot of practices that can make their operations more efficient, that can help them increase their margins without necessarily ruining the product. And so there are also ways that financial institutions can be experts outside of finance, especially in the more business space. The third thing is that these are centralizing bodies, which means that there are benefits when everyone just transacts with the same body. So rather than all of us looking for individual partners, there are benefits to us going to the same place and then having this one body kind of figure it out for us. Um, there are a lot of them. Number one is scale. So just the fact that, and in relation to the other two, right? When I have the um, scale that I'm handing out many loans, but I'm also able to take on deposits from many different customers, it ensures that one of these loans is not going to completely bankrupt me. And that helps. It also helps with expertise because it ensures that when you have a larger portfolio, you are able to also have kind of like in general math or experiments, right? Sample size affects the likelihood of reaching an expected value. What I mean by that is, and let's take a more concrete example. Um, let's say in the context of insurance, you will pay for an event. Like, let's say you have life insurance, and if somebody dies, you will pay out to their family a certain amount. In exchange, they will give you regular payments. If I'm insuring one person and they die in a year when the plan was for 30 years, I will lose a lot of money. Whereas if further on that, you don't know when to expect that to happen, or you won't have the best guess. So let's say, for example, you are insuring people who are about 40 years old, and you expect that they will survive on average 30 more years after 40. When you have one person insured, that's a lot of risk because maybe the average for a 40-year-old is to live till 70, but a lot of individual people will fall out of that average. So what if they get into an accident or something happens in a year? That doesn't bode very well for you. Whereas if you are insuring millions of people and on average you know that they will live till 70, you're not going to get one of these random outliers that could completely ruin your risk. And that makes insurance a sustainable and profitable business, just having that scale. It also allows for specificity. So like I mentioned a while ago in the saver spender example, um, what if the saver just does not have enough to cover what the spender needs? But if you pool together like hundreds of different savings accounts, even if they're not a lot, then maybe you can now finance a mortgage. And it's not just that. If I'm looking to make a financial transaction, like on the stock market, I am also much more likely to find um, someone who's willing to buy what I want to sell, and the converse, someone who's willing to sell what I want to buy. Because just the sheer number of people allows you to both find a more specific partner, but also pool together funds that allow for a more specific transaction. Third is convenience. Maybe, for example, you can just chase someone down for money they owe you. Maybe you can, what do you call this, track the stock market every day. You're smart enough to figure out what investments to make. Is it really worth your time? The whole point of like a lot of investments is that you're not working. You are working a regular job and making money off that, and then investing so that you can make money without having to work for it. But then the more that you turn it into work, the less worth your time it becomes. Having someone do it for you is pretty useful. Liquidity is a big thing, meaning having someone to transact with and being assured that you can sell it as well. So it's a two-way thing, which is when you have one body, it becomes a lot easier for people to make these transactions. And secondly, knowing that you can make this transaction again makes you more likely to make that transaction. In the sense that I might buy a stock because I think it's not very hard to sell that stock because I know the stock market exists. And because I'm willing to buy that stock, that increases the liquidity as well. It now ensures that someone who wanted to sell that stock has a partner. Whereas, for example, a less liquid market, like for example, if I wanted to buy a collectible, like a Funko Pop. One thing I'm thinking about if I'm seeing this as a purely financial investment is that it might be hard for me to sell it because not many people might want whatever Funko Pop I'm buying. Last thing is access. So when you have a centralizing body, it also ensures that they can find ways to make money by expanding the number of people in which they serve. So for example, if I'm a bank, I'm entering into more geographical areas, making sure that more people are using me as an intermediary because it makes the whole system better. A good example of that might be like payment apps, where it's not very useful. If you're Filipino, think maybe Gcash. If you're American, I don't know, like Venmo, PayPal. But if everyone's using me, then it makes more sense and my product makes more sense. So it would be very difficult if I'm on a payment app, but all of my friends are not on payments apps. And then when I pay them back for dinner, they're not going to use the same app that I'm using. So how does finance affect regular people? I wanted this section here because I feel like sometimes in debates, people will settle for conclusions that I don't think are necessarily in themselves end goals. So for example, a team might argue this helps small to medium enterprises. That could be a good thing. It could also not be a good thing. In the sense that, what if big businesses were more efficient? What if big businesses hired more people? What if big businesses were more stable and ensured there would be less cost in case of like a financial crisis? Not to say small businesses are bad, but more that this is an unfinished conclusion. There had to be more of an end goal in that argument. You would have to prove maybe small businesses are the better employees. Small businesses cater to more people, things like that. So here are, I think, the end goal of many arguments. Number one, regular people have their money invested in the financial markets or are affected by institutions who do. So I think this is very clear, right? If this is your life savings, if this is your retirement, if this is what you were using to pay for your kids' tuition, this should be an amount that's probably protected. So for example, in the 25% of investors in the public equity market are individual investors. So everyone will talk about all the big institutions owning all the stocks. Sure, but 1/4 is still a large amount. And importantly, these are large amounts to the people who have money in them. And these people do either of the following. One, they're either actively buying and selling based on their outlook, meaning if I think the stock will go up, I'll buy. If I think it'll go down, I'll sell. But there's also a larger and larger pool of people who are placing their money in ETFs or exchange traded funds or different funds, mutual funds, for example, where instead what's going on is you put your money in a fund that will invest it in a pool of investments. So, for example, you might have a fund that tracks the S&P 500, which would give you a fairly diversified, maybe increasingly less so, investment that tracks the overall health of the economy and has historically showed gains. So if you invested in the S&P 500 decades ago, your money would have like multiplied by quite a few number of times by now. It is not the biggest investment in the world in the sense that it won't quadruple your money in one night, but it could very reasonably multiply your money over multiple years at a time. It's seen as relatively safe, but still not the safest investment in the world. It can be prone to a market shock like COVID, or market crashes like in 2022. So more and more people have their money outside of the traditional financial market. I mentioned this because I think that the specific instruments here might not be trends in debating forever, but I do think this general idea that people are investing it more outside traditional finance will likely stay a debating trend for a while. So Warren Buffett, for example, thinks we live in a peak of having a gambling mood. There's the massive growth of cryptocurrencies and prediction markets is largely due to people feeling distrustful of the traditional financial system after 2008. They feel like this was the actions of like the big banks and that they had little to no say over it, except maybe wanting to buy a house for themselves. Is that really such a bad thing? It was the failure of governments to act responsibly and for encouraging this behavior after large-scale deregulation, especially around Reagan and moving on into multiple administrations in the future. Um, there's also this like trend of economic pressure. When you have rising inflation, a pretty tough job market in many places, and rising costs of living in general, there's a higher willingness to risk money to make it out. Meaning, if I work this job for 30 years, and this is like the perspective of a lot of people, I will not become a millionaire. But if I put my money in Kalshi, if I put my money in Bitcoin, and I saw that this made millionaires of people, then maybe I might just be a millionaire. So that's the logic of a lot of people entering into these places. And it's not, I wouldn't say it's finance really anymore, but that also applies to things like the huge rise of sports gambling in the US. Third is digital media and integration of these platforms. Mostly saying that they are trying to sell you this, like through advertising, through the different platforms you encounter on a day-to-day basis. I would say in sports, for example, which is the number one kind of transaction on Polymarket and Kalshi, it's hard when you watch sports and these are actively advertised to you to really avoid the temptation to want to enter a bet, especially the strong inclination that, you know, the over-under on like 17.5 points for this player is probably a good idea. And importantly, it's becoming easier to do it. Before, to gamble or to enter into an events contract with Kalshi or Polymarket, you would probably have to go to a casino, make an active trip there. Now it's just a few buttons on your phone. That's really made it a lot easier. So the second way is very indirect. People have their retirement money handled by pension funds. And so it's not the case that these pension funds had held your money for the longest time and are now just giving it back to you. A lot of the time, like if it's a state pension fund, for example, they will take some of your income or tax money, and then they will invest it just so that when it's time for you to retire, it's a reasonable amount. You know, it didn't just sit there; it was growing, and that's its exposure to the financial markets. Employers also sponsor retirement accounts by having both employees and employers contribute to a pension fund. I think the way this works depends heavily on where you're from. If it exists, depends heavily on where you're from. But I would say it's also a pretty easy way to impact the debate, especially in debates that involve a demographic transition, where there are an increasing number of like older people compared to younger people. The tricky thing now is when you're handing out a lot of these pensions, but not really collecting a lot in tax. There is more pressure to find strategic ways to grow them through the financial markets, because that's the way you can offset the proportion of aging and young people. Insurance companies need to invest their funds to ensure they can meet future obligations. So I would say this impacts people because someone might think, well, my insurance contract is assured anyway, right? So if I die, I'm definitely getting this money. I'm not really sure why I care about whether or not it grows. But really, well, one, it avoids the insurance company from crashing, but two, it affects the pricing. So perhaps if they have fairly sustainable investments, they can make their premiums cheaper and attract more people to enter, or they can make their payouts larger and attract more people to enter. But obviously, that depends on whether or not they can have these growth and investment strategies that work. There are also just a lot of institutions that you might not realize are investing in the financial markets. Schools and their endowment funds do this, hospitals do this, and that's because they understand they're not gonna have to spend on such a regular basis that their margins are completely like razor thin, right? A lot of them do have money to grow, but they realize also that their costs are increasing, and when they have to spend on stuff like a new building, for example, these are fairly large costs that they can't just, you know, one year decide, let's finally do it. It has to be a fairly planned out strategic decision, and therefore having the investments to back it up can be quite useful. Number two, access people have to capital is heavily determined by the financial sector. So, like I mentioned in Saver Spender, many people need upfront capital to either cover their expenses or to have productive use of this capital. Um, I'd say something that affects most people in most countries is really just home ownership. A lot of people can't pay for a home in upfront cash, but they can take a mortgage, right? They might not be able to afford it now, but if we stagger those payments over a long period of time, maybe they can afford a house. And most people in the developed world no longer really carry cash, but they carry credit cards. And that is exposure to the financial system because the interest rates around it, how they promote it, and the benefits that come with it are heavily determined by the financial system. Fintech is doing this for more and more things as well. So, fintech, I would say, really wants to integrate itself into your daily life. So, buy now, pay later is affecting how people do groceries, even how people buy an appliance, how people buy electronics, etc. And of course, all this access to financing comes at a cost. This is where most of the debating lies, meaning no one's going to say that nobody deserves credit or that different groups of people don't deserve to be able to buy a home. What they will probably say instead is that there's a huge debate about the ethics and practices within these sectors and the likelihood of pursuing ethical lending, for example, or having ethical and interest rates, and whether or not people can make financially sound decisions with respect to them. Number three, finance affects the health and capacity of companies and therefore work and wages, which is to say, the ability to employ people, provide wages, the attitudes of companies, especially around what is a fair wage, how much people should we have on board. It depends heavily on the financial markets. So, for example, a startup can gain capital through investors and become very large companies that expand and expand and expand and hire more people in the process. Companies, so this is flip direction. Companies who are unable to access funding and have a poor financial outlook may have to lay people off because the financial market doesn't really think that they have good prospects. And so, how are you going to pay people in the short term if they're not going to lend you money unless it's for a high interest rate, for example? Or no one wants to give you equity because they think that this is not a worthwhile investment. There are also discussions around like labor rights, ESG goals that depend a lot on investor attitudes. And that isn't to say that, and I think this is important, in a lot of debates, there is this presumption that all investors are just all evil all the time. And to be clear, I do think most investors, right, have some kind of self-interested profit motivation. I think the important thing to do in this debate is not just to make a caricature of all these actors in financial markets, but really explain how, for example, ESG goals could tie into investor incentives. Because I would argue, for example, that the push for ESG is actually quite prevalent in private equity, in a lot of different financial institutions. Is it perfect? Is it the panacea to all of our problems? That is an entirely like different question. But I think what's important is to be able to rationally explain why is it that different financial actors act in a specific way and what their interests might be. There's no greater show of this than in times of financial crisis. Meaning, the likelihood of a financial crisis, I would say, is heavily determined by the financial sector. And that affects everybody, whether or not you are in or out of finance. Because when investors and creditors are too afraid to provide capital, and also need capital themselves, right? A lot of this is based on the fact you can cover your expenses. But if your expenses are starting to increase and your profits are starting to decrease, then you're just going to hand out less money as well. So companies need to somehow earn revenue and cut costs in an environment where people are afraid to spend money, both on the investment side, where they're not willing to lend debt, they're not willing to provide equity, but also on the consumption side. So when individual people are saving up their money, it's just less likely I'm going to go out and buy food, for example, rather than buy ingredients and then make it at home. And what that does is, if you're a restaurant business, things get very tight, very tricky. The financial sector and how incentives/systems are constructed in these times do a lot. And the way I look at it is kind of as a timeline. So before, how often do these happen? Do they create sustainable financial industries that are by nature wary of risk and not just willing to, do things gung ho, like whatever happens, happens, and if we make a lot of money, we'll make a lot of money? Or are they quite prudent? And are they able to prevent the worst of things before they happen? Second is, how bad can they get? So during the crisis, how are they acting? What are the stopgap measures? What are the preventative measures they might have taken to make sure things don't spiral out of control? And lastly, what are the options for recovery? How do you get out of a financial crisis? I think an important note here is that finance connects all industries, right? If you are a non-financial company, you have to put your money in a bank. You need investment. You need to transact with other people through a financial intermediary. And so when there is stress in financial institutions, there tends to be a lot of contagion and huge effects on everybody else. The difficult thing is that once there is a sense that there is contagion, or once there is a sense that financial intermediaries are starting to experience stress, that increases the contagion. Because, for example, for a bank, if I'm pulling out all my money because I'm like, this bank might crash, I need to save my money, then the bank is more likely to crash because now they don't have any money. So when everyone acts in their own self-interest, the trick there is that it becomes less healthy for the system as a whole. But can you really encourage people not to act in their own self-interest, not to take their money out of a crashing bank, not to pull out investments and be strict with credit in a time where you're not sure you'll be paid back or you'll make that money back? So it's very tricky how to handle these complex situations. Number 4, the financial sector determines value and shapes the business environment. Since investors expect long-term returns, they often have to invest in things that they conceive to have future value. What I'm just trying to say here is, what is that value? What do I think will be the next big thing? I think the clearest example of that today is AI. And there is one side that will say AI has fundamental transformations on how any industry works. It increases productivity. It makes companies way more efficient at a fraction of the cost. There's the other side that will say it's hype. We're not ready for this. This is like promising technology, but the amount of money that's been poured into it and the expectations of it are unsustainable and unrealistic. So this value determines a lot of what decisions companies make. So what am I willing to invest in? What am I willing to put money in? And also, as a consequence of that, what new companies will have as their business model. So there's a lot of AI hype now. Every young Silicon Valley startup bro is thinking, I need to make an AI company because that's the big thing and I have to get in while people are getting funding. And it also affects what other investors want to invest in because, like I mentioned, you want to sell this thing, right? And so it doesn't just matter what I think is valuable, it matters as well what other people think is valuable. And this affects people as consumers. So what kinds of products and services are available for everyone? How are they priced? Is the goal access and everyone can afford it? Or is the goal catering to a specific demographic? It affects quality and how good these products ought to be, how valuable they are, what expectations consumers have, and the overall nature of goods and services we buy and sell are just heavily influenced by the financial sector. Because this idea of value, you can do a lot of math, you can create a lot of models, but all those things will be based on assumptions and will be based on more qualitative decisions like business strategy, a sense of what the market likes. You can quantify these things to some degree, right? You can have surveys, you can find ways to do market research, but they're not always going to be perfect. Last, I don't think this is the most important thing in debating, but the financial sector is a sector in itself that employs people and determines growth. In real life, like obviously this has effects on a lot of people. Not to say that that's not true. It is to say, however, I don't think a lot of motions will be about this pretty small group of people. So the financial sector exists to a different degree, like different degrees in different countries. So Singapore, for example, is a huge financial hub. The amount that the financial sector employs, the growth of the country, those are things that I think have very large impacts. So when this comes up in debate, I imagine it's either in a case like Singapore, where the financial sector is just such a big chunk of what this geographic location does. So when discussing cities primarily known as financial hubs, for example, New York, London, Chicago. Chicago is where all the big like derivatives markets tend to be. I've also seen debates about individual career options. So, like, would you rather be completely altruistic in terms of your work, or would you rather make a lot of money and then use what you get from your income to do altruistic things? Um, yeah, I think definitely room for debate here. Hopefully, some of those things are useful, but I also don't think this is the biggest impact in many cases. What matters in finance? And what I mean here is like, I think most financial transactions can be distilled into what I'm about to discuss. And this is what I mean by let's look at it from a principles first and fundamentals first perspective and then specify later. So number one obviously is value, right? You don't put money in things that you think are worthless, and there are two types of value. Number one is called fundamental value. It's also known as intrinsic value. It's the worth of a company determined by its real value. And it's usually measured on objective metrics such as profitability. So is the thing that I'm investing in making money? Let's say I want to use the example of a house that I'll return to in the future. But the fundamental value of a house is that the land on it can be used for other things in the case that it's not a house. The fact that it can be lived in by a family and the family would be willing to pay for that house. These are things that are intrinsically valuable. The second is what we call technical value. So it's market value. It's the perceived value based on measures such as price trends. So you're not looking at the underlying company of a stock, you are looking at the stock. So if in fundamental value, let's say I'm looking at the stock of a big company and I'm analyzing that company and I'm saying this company is making a lot of money. Technical value is just saying the stock price of that company is this much and I expect it to go in this direction. Because when you buy something, you don't just want to extract the value it might give you, but also consider the fact that you might want to sell it to somebody else. So this is the market value of a house. It's not just the fact that you want to live in it, but that it is an investment for your family, that other people might want to buy it in the future, things like that. And it's reactive to supply and demand because supply and demand by nature are dependent on the perception of other people with respect to the value of that rather than the actual usage of it. The next thing is time. Going back to the saver spender example, we see that the spender needs money now and the saver has excess capital now. But you'll notice that the saver expects more money in the future. They're not saying, pay me back the same amount. They are saying, I need a reason to engage in this transaction, so you have to pay me a bit more than what I lent you. In almost all cases, except maybe exceptional cases of deflation, an amount of money is worth more now than the equivalent amount of money sometime in the future. This concept is known as the time value of money for a few reasons. Number one, you can use this money now and invest it, which would have led to a greater amount of money in the future. And importantly, there are relatively riskless investments. So for example, I have the option to get $100 now, or I can invest in $100 in the future. There are riskless investments in the form of, what do you call this? Like lending money to the government, especially in a very stable government like the US government. Let's say I can make 6% interest. So if I get the $100 now, in 1 year, that 100 would go to 106. And that's already more than the $100 I would receive in a 5 years amount of time. So it's not really worth it for me to wait. I need that money now so I can make money on it. Second is that most economies exist in an inflationary environment. And the healthiest economies in the world are not experienced like a stagnant or deflationary economy. A lot of them have inflation at a fairly controlled and small rate, like 2 to 3-ish%, a little bit more or less, depending where you're from. But essentially, what that same money could buy in the future would be less. So maybe it's the same money, but if it has less purchasing power, it's not really worth it. And third, a future time introduces uncertainty versus the certainty of knowing what you could get for your money today. So just the fact that I'm not sure that there is risk already lowers its value. So in the example of a housing loan, if I'm gonna take a housing loan, I get money today, but you have to pay more than that in the future. You need to compensate them for the time, right? So if I get $1 million for a housing loan, I don't expect that I'm going to pay back $1 million even if you cut up the payments into smaller parts. The sum of my payments will be well over $1 million. All right, risk and return. So finance expects that you are compensated for taking on risk. This creates incentives to take on risk and that you build capacity to do it well. So there are two parts to this. Number one, there's no reason for people to take on risk unless there was a corollary reward. And so ensuring that people are compensated for it also encourages them to do risky things that might be good for the economy, right? Like lending someone money might be good for the economy because it allows a house to be bought, it allows a car to be bought, but it's a risk. What if they don't pay me back? So you need to be compensated for that risk you're taking on. It also builds capacity. So it's not just that you get money and there's an initial interest, but also if I lend more and more and more money and I get profits from it, then that increased profit also ensures that I can lend more money out. And at the same time, if one of those people starts to default and not pay me back, then at least I have built a cushion for myself through the profits. There are, I think, three most common types of risk. There are other types like strategic, reputational, business risk, but these are the three most common types. Number one is market risk. So this is a risk due to movements in market variables. So if I bought something that depends on a stock price, if I bought something that depends on an interest rate, that's market risk. Credit risk is the failure of a borrower to repay or loan or meet financial obligations. Very simply, I lend money, they don't pay me back. That's a risk. There's also operational risk, so failure due to systems, people, and processes, both internal and external. This is a very wide range, and one of the troubles of operational risk is that it's very hard to quantify as well. Because market risk, there are a lot of pricing models for a stock, there are a lot of ways to price the default of a loan, but how do you measure fraud? How do you measure natural disaster and its impact? It can be quite tricky. Important notes. Number one, not all risks are rewarded. So the expectation is that risks are rewarded, but sometimes people will just do things that don't compensate them for it. So for example, if a rewarded risk is if I charge a higher interest rate on a riskier loan. That's risk that's rewarded. But if I have poor cybersecurity that leads to a cyber attack, this is a risk, but it's not rewarded. There are very few cases where this is a risk that pays off. So you need to analyze the direction of risk, the proportionality of risk and reward, and the ability of the risk to create the reward. What does that mean? Long story short, what does the risk that you are creating or taking do? Is it sufficient to compensate you for the reward that you get? Because you might get a reward for your risk, but if the probability of that reward is really small, or the amount of that reward is really small, it's probably not worth it. And the ability of the risk to create the reward. So, let's say, for example, interest rates. One of the difficult things with interest rates and lending is that when you have really, really high interest rates, it can also damage the ability of a borrower to pay you back because you're financially incapacitating them. I think the clearest case of this is a loan to a business. If I lend to a business and the interest rate is so high that it becomes difficult for them to run the business, then and they're spending so much money paying me back at the start, then they might not be able to repay me all of the loan. And so you have to understand, how does the risk that you create um, also create the reward, or possibly the opposite, damage the ability to create that reward. All right, note two, risks are not just created actively, but can also be created passively. So I think, and I see this in a lot of debates, right? Um, People want to avoid doing a bad thing, but in the process, they can just omit, like, sin of omission, have a risk by not doing enough. I think risk needs a proactive culture and needs proactive like measures to be taken a lot of the time. And it can create risk when you avoid doing something necessary for your survival. So if you let a competitor company have an advantage because you didn't want to risk investing in a new technology, and I think this is the case for a lot of um, like legacy systems, right? Like a lot of them will be like, we have been used by companies around the world for like 30 years. This new competitor is just hype. We don't really have to do anything about it until they are replaced. And then it becomes a big concern. I think a good example of that might be Skype, which had this huge control over video conferencing for a long time. And then Zoom comes in, and there are very few alternatives that are uh, really meaningfully competitive these days. Second, failing to upgrade your internal process to avoid the possibility of birthing pains and upfront costs. So you're like, you know what, we don't really need to, change our systems because it's costly, it's going to confuse everyone. But then it turns out maybe that's what you needed to prevent a fraud. Maybe that's what you needed to ensure the health of your business. But then you avoid it out of fear. Third, not entering into a new market, which ends up being the majority of the market for your product because your old market is considered safer. So, for example, let's say you're not catering to this new demographic because you're like, we're solid in this older demographic of people, it's fine, we don't really have to do it. But then it turns out older people are turning away from the industry as a whole, and younger people are now the primary consumer. So, by failing to at least take part in that pivot, that has created risk for you. Long story short, you don't just create risk by avoiding risk. You also have to proactively do things to avoid risk. Alright, third, risk is sometimes necessary and it doesn't have to just be avoided. There are a lot of things you can do with risk. Number one, you can absorb or retain it. You just be like, this risk is worth it. We can keep it. It's fine. If the reward is greater than the risk, of course. Number two is it can be mitigated. So you can take on some of the risk, maybe just not all of it. So for example, if I require a down payment on a loan, like let's say the loan is for $1,000,000, and then I say, pay me $200,000 in cash that I will use, let's say it's a house, pretty expensive house, but like, let's say it's $200,000, I'll use it to buy the house so that I don't have to use my own money. I mean, there's less reward there because that $200,000 is not going to earn interest. But it's also less risk because you're like, well, now they've put in some of their own money, right? Like, I'm assured that they're good for $200,000, but also that they're not just getting money that they don't own and using it to finance a house. Third, risk can be transferred. So you can move this risk from one party to another. And importantly, some parties are just better at taking on risk than other parties. So, for example, an insurance company getting or providing insurance to a manufacturing company for a factory makes a lot of sense because maybe the manufacturing company now has to pay regular payments, but the risk is now with someone who knows the likelihood of the risk, who knows what to do in the case of the risk, and has a portfolio of these risks such that a few of them potentially, for example, getting flooded and having a natural disaster ruin them won't completely bankrupt them. Whereas for the manufacturing company, it might bankrupt them, right? It can also be transformed. So sometimes you feel better suited to take on one type of risk than the other, and so you will transform that risk into the type that you're more willing to take. So let's say, for example, you are an American company and you are currently based in, I don't know, the American Midwest. And you start to see this is not the best environment for American laborers. This is not the best environment for American manufacturing. I'm going to move to a different country. Let's say you move to Mexico, which I'd say is decently common these days, actually. Um, and you're engaging in different types of risk, right? There is now a risk to the currency that you are paying and receiving, right? And your exposure now to like a fundamentally different currency. You're exposing yourself to a different set of regulations. You're exposing yourself to different types of like economic policy. But you might be more optimistic, for example, about these risks. And so you might think these are risks I'm willing to take. The risks that currently exist in the US are I'm not so willing to take. And that's why you might transform that risk in that way. Note 4. Regulation can discourage excessive risk taking, but has some drawbacks. So a lot of debates will be like, well, why can't we regulate it instead? Would be nice, right? Like, if we could just fix everything through that. Of course, some of it is a problem of the appetite for regulation. A lot of like people just don't want to regulate things. But some issues with regulation itself are regulation tends to be broad and all-encompassing. So it's hard, right? Because you want rules. And importantly, everybody wants everybody else to follow the rules, right? You can't argue too much, at least, that some institutions will follow these set of rules. Other institutions will follow these sets of rules. Because the institutions won't be very happy about that. They'll be like, what? Why are you being so much more punitive to me compared to another body, for example? And so having fairness is, I would say, pretty important. The problem with that then is that they might not be fit to the profile of every company, every financial institution, etc. To some degree, there is like a mix. So what a lot of banking regulation does now is they will say if you have this much assets, you will have lesser requirements. And then if you have more than that, you will have more requirements, for example. So you get a mix of wanting everyone to follow the same rules, as long as they are in the same relative competitive environment. And at the same time, not making sure that these rules are completely agnostic to the conditions of these individual institutions. Second, this would be risk regulation can be pro-cyclical instead of anti-cyclical. What I mean by that is, and some of the theory around this is that when the market is running hot, right, like everyone's making money, everything seems to be going up, everything seems to be going well for everyone, that is when you probably want to say, guys, let's pocket the money we've made and let's play it safe. Instead of, guys, let's keep this market going. But that's the thing. It's very hard when everything looks good to tell everyone, how about let's just make less money than we're making right now. That's not very popular, especially among like large institutions that might be making money at that time. And then the opposite's true. In the time of a crash, you want to be like, guys, I actually think we need to loosen all these restrictions because you don't get reward without risk. You don't get returns without risk. And if I, for example, tell banks to keep more in their reserve, that discourages economic activity. And so it's when things are going well that regulation is more apprehensive to regulate. And it's when things are going poorly that regulation is more apprehensive to encourage like booming business environment that tends to, instead of breaking economic cycles, they tend to encourage them instead. Not always true, to be clear, right? And I think prudent regulators would not say that this is the case. But it can be the case many a time. Last thing is regulation can be anti-competitive. So like I mentioned, if everyone's following the same rules, it's a big question of who determines those rules. And obviously, the biggest lobbying groups will come from the most powerful people in the industry. And there's also just like this dependence on the largest players in the industry. So, for example, in banking, you do kind of want to cater to the largest banks because they want to make sure that they're safe. You want to make sure that you have a good relationship with them. You want to make sure that they, the ease of transacting with other people, the ease of getting your money, etc., is relatively high, especially for these big banks. But it can also make it very difficult to question them. And importantly, when smaller like competitors offer better services, maybe do more for their customers, then regulation can be used to quash these kinds of groups, and make it difficult for them to survive in this environment. So, on one hand, you can argue that it's a safety measure. On the other hand, you can argue it's an anti-competitive measure. All right, banks. I think we're gonna get to like 2 hours. How do banks work? I will take a bit of a break, but I will continue the recording. All right, I am back with a dog. So how do banks work? The core business of banks is really that they take deposits and they hand out loans. So they profit from the difference in interest offered between the two. Meaning, if I'm going to encourage you to take on a savings account in my bank, usually they'll give you like a 0.0 something percent interest rate. And then when they give out a loan, they'll give an interest rate that's in the single digits, 4, 5, 6%, something like that. And so that difference is the core of where banking makes its money. They provide a lot of other services, so they'll help transfer funds. You can move money from bank to bank. You can exchange funds into different currencies. And in some cases, they might provide you the option to invest. This is, I don't discuss this in the rest of the lecture, so I'll briefly discuss this now. A very big point of contention, whether or not banks should be allowed to make investment decisions. Because on one hand, you can argue that, well, they have the financial expertise to do so, obviously, but also that this might help increase the general funds that they have. So the same logic from you allow a retirement fund, right, to invest because it'll allow it to grow in the future. You could also argue that you should allow a bank to invest because by growing their general like pool of wealth, it would also ensure that what do you call this? It would also ensure that they can maybe create a cushion for risk, or that they can pass on the earnings that they have to either maybe improving services for their customers, increasing the rates. So, for example, if I'm making a lot of money on my investments as a bank, I need money to be able to invest, right? So, what I might do is I might say, I will raise the interest rate on your savings account. So, from a very small percentage, I might move it to like a 1%, which is very high. But they could do that theoretically. I'm not saying that they would in real life, just for the purpose of illustration. And an important thing here is the concern is whether or not they should do it over deposits and savings accounts. So usually, if you tell the bank, I want this money invested, and the explicit purpose of it is investing, then it's fine. The tricky thing is if I am like putting money in my savings account and whether or not they invest it. Some countries are very strict. That's a big no-no. Reason being that that would also, in the case of a market downturn, it can have very costly impacts to the bank. And importantly, the overall safety and health of a bank is very important to preserve in the period of a financial downturn. Because when people start withdrawing their money, other people's savings might start to crash as well. You can argue that banks would have been prudent with their risk management anyway, and that this builds a bigger cushion for those times where there is a crash. There's also an argument to say that, like from principle, on the other hand, people don't, like they put their money in the bank with the expectation that it is owed to them, and at best, like lending it out is still a legal obligation. If I take out a mortgage, I'm legally obligated to give that money back. Whereas for an investment, there is no legal requirement that you will earn money on that. And so it would be uh, unfair for people who are just, everyday people working hard and then putting their money in a savings account only for the returns on an investment to go sour and the bank go under. An important aspect of banks is fractional reserve banking. So banks don't hold everyone's money all at the same time. Otherwise, they couldn't hand out loans, right? So if I was just holding everyone's money, then there's no space for me to give out a loan to other people. But the tricky thing is that you have to hold how much is likely to be withdrawn and give out a proportion of the remaining amount as loans. The way you can think of a savings account is actually a loan. I am lending the bank my money. But the hard part about this loan is that I can ask for the money back at any point in time. So when you put your money in a savings account, you expect, right? If you need like $100, you could go to your ATM and then withdraw it, or spend it from a debit card, for example. But the hard part about that is that they need to give out some of this as a loan. So how do they expect, and what should they do with respect to keeping aside enough for regular withdrawals and spending, and at the same time giving out enough that they're making money? Why do we do this? Why is the system that we have? Well, number one, it increases the money supply and can translate into real economic impact. What that means is, if I keep my money in a bank, that is money that is not circulating in the economy. That is money that is sitting there doing nothing, and it has effectively decreased the supply of money. Yeah, I could take it out, but usually I would only take it out if I intend to spend it, right? And that instead translates into real economic impact now, because now instead of it sitting there, it can turn into a house, it can turn into a car, it can turn into a business that could hire people. Second is that money locked up, like right I mentioned, it does close to nothing, and it now becomes an economic driver. But there are some challenges that come with determining, well, how much exactly am I going to set aside, right? So, like I mentioned, deposits are expected instantly. But the flip side of that is that loans are long term in duration, meaning I expect my money ASAP when I withdraw it, but then the bank expects their money over like 20 years, 30 years, with a housing loan, for example. Second, banks must keep the expected amount of withdrawals and keep this in reserve. Um, how do you predict this? Because if you just do it based on the average, there are a lot of times that things go over their average. And if you don't have that money set aside, um, an important aspect of banks is, like I mentioned before, there is a contagion effect and a psychological effect. You can't just go over, or rather, not have enough money for withdrawals one day and just expect it to be chill and be fine. The moment that a customer tries to withdraw and realizes that the bank doesn't have enough money, everyone is freak out. Everyone panics. Because they're like, oh my god, did you hear that the bank didn't have enough money? You have to withdraw your money now to keep it safe. And so banks really have to avoid this kind of situation because it can turn a bad situation worse and much hard, like make it much harder. Um, and importantly, bad economic conditions affect both sides of the coin. So in bad times, people need liquidity, right? In bad times where people get laid off work, in like especially in challenging like economic crises, people get laid off work, they're paid less, and so you need to eat into your savings to pay for your expenses. So banks get more withdrawals. But also, if you borrowed money for a housing loan and now you're realizing I can't really pay this back, you're more likely to default. And so banks are getting less money from their savers and are losing the money from their spenders. And so the challenge is, how do you stay afloat during these times? Well, we manage these risks in a few ways. Number one is minimum reserve requirements. the what I mentioned a while ago is like keeping just what you expect. Banks will often keep well above that, but to make sure banks don't get a bit greedy, right? Like they don't create a calculation that will allow them to maximize how many loans they're able to hand out at the cost of risk. Is that the like regulators of any financial industry will put a minimum requirement to make sure that a bank holds on to a certain amount of money at any point in time. Second is you can have deposit insurance. So what this looks like is you will have a third party insurer telling you, even if this bank crashes, I will make sure that up to a certain amount, you will get your money. In the Philippines, I think it's like 500,000 pesos. So if you put 500,000 pesos in a bank, and that bank is in PDIC, I think Philippine Deposit Insurance Company, insured, and that crashes, you will still get that 500,000 back at the very least. And this is not just good reactively, it's good preemptively. Because now I'm more willing to deposit my money in a bank. And that keeps the system more stable as well. Third, and really common, banks do interbank borrowing. They lend money to each other at a cost. And this allows banks to meet their reserve requirements every day. So maybe you don't have the amount of money required, but you can always borrow. And so there's some confidence that, you know, the overall health of the financial system is at stake. These banks will not just be completely selfish and say, oh, we want this bank to crash. You still want the health of the system as a whole to remain afloat. What do central banks do? An important note here, I will look at this mostly from a financial perspective. There are probably more economic perspectives on this, especially with respect to controlling inflation, etc. I'll talk about it broadly, but I want to talk more about the banking side. So central banks around the world have different mandates, but are often focused on price stability. Um, it depends on the central bank. You can probably Google your own central bank's mandate, but usually they will focus just on making sure that prices don't go completely out of control. They will have secondary mandates. Some of them might want to reduce unemployment. Some of them want to promote growth and have other economic priorities. And this affects a lot of the actions that are taken by this bank. That's why a lot of them will look at inflation data, but a lot of them will also look at jobs data. So if, for example, jobs look good, there's relatively low level of unemployment, and inflation looks good, then a bank might not change its rates. But if inflation gets very high, then it might have to do something. What is that something? One of the most powerful tools of the central bank is control over the interest rate, because this directly affects the supply of money in the economy. When interest rates are higher, this decreases economic activity because the effect of borrowing is higher, or the cost of borrowing is higher. So people are more hesitant to borrow money, right? So if I charge you more for borrowing money, you're going to be more hesitant to borrow money, and in exchange, or rather, as a consequence, more of that money stays inside the bank, therefore decreasing the supply of money. Um, and that also decreases spending and decreases demand. And by decreasing demand, so people have less money, more of that money is inside the bank, that less money is spent on less things. Um, and because people have less money, there's also less demand. When things have less demand, given supply and demand, things will also cost less. Um, and that's a very simple way to go about it, but that's the way that central banks affect the overall money supply and whether or not prices should, or like, it goes both ways, right? They can also cut interest rates and the opposite thing happens. And so it's this constant determination of, are we at the point where prices are stable, prices are relatively controllable, and we can afford more economic activity? Or are we at a point where there's a lot of economic activity that is driving prices up, and therefore it's very important for us to control the price before it gets out of hand. An important thing to note is that this is not a perfect relationship. Of course, inflation is one of the targets of the central bank, but it is not certain that just by raising or cutting interest rates, inflation is going to be like affected in the way that is expected. A lot of inflation could be due to a lot of different things. So, with, for example, the war in Ukraine, um, a big part of that was that it was an issue of supply, meaning there was just a difficulty to produce a lot of the goods that we were previously producing because of the effect of the war on global trade. And what that did was that it made things more expensive because we had a lesser supply of goods. But then a lot of the time, central banks, what they target is demand. Um, and so when consumers have less money to spend, they have a less demand. Um, you can argue to some extent that this will address inflation to a degree, but without addressing the root cause of it, there's also a question of whether or not it's worth the possible negative impact of, um, what do you call this? Reducing overall demand, which is reducing economic activity in general at a time where we might have needed it. A lot of debates on that. An important part, given those debates, is that they are independent. This ensures that politics does not influence the actions of a central bank. A lot of reasons, right? Like you can argue people or the everyday person doesn't understand the complex relationship with interest rates and jobs and inflation. You can also argue that a lot of central bank decisions may be unpopular. So if you raise interest rates, which decreases economic activity, this reduces jobs, reduces wages, but might be an important tool to counter inflation. But it might not look good because you're losing jobs and you're like reducing wages. Um, this also makes them unaccountable to the public. So when you have a central bank that's independent, it also ensures that they're not answerable to the will of the people. Big question of whether or not that is a good or a bad thing. I would say in modern times, there's a big challenge here from Trump. So there was public pressure on Fed Chair Jerome Powell, Jay Powell, where Trump is publicly tweeting like, you have to lower the interest rates because, like I mentioned, lowering interest rates tends to be relatively popular because you increase jobs, increase wages, increase activity, and so there's like this public like sentiment about it. There was a DOJ investigation into the Fed's building renovation and questioning the prudence of that spending. And Trump, so the president gets to elect the governor of the central bank. And so you can also question whether or not that selection process is going to be independent. Um, the tricky thing is that, and you'll notice it's a bit of weird timing, they have terms that don't necessarily line up with the terms of elected officials. And so it's not also the case that you can campaign on electing a certain like Fed chair. Um, and there's also the question of like maybe the Fed chair will be accountable to you prior to your selection of them, but once they're in office, they might not be as willing to bend to your whims. You can see that, and to be fair, you can argue whether or not they were not independent at all, but you can see that with a lot of, like, analogously, Supreme Court justices that were appointed by different people that voted, arguably against the interest of the party that put them in power in certain Supreme Court decisions. And so it's not certainly that the nature of appointment is completely ruins this independence either. An important bit I would mention is that central banks are not just these interest rate controlling like robots. They also create regulation for the banking industry. They recommend best practices, how to handle things. Like they probably have advisories on AI and like new technologies that are popping up. They provide a supervisory role. So central banks also often audit financial institutions. So they will literally go to these banks and just check that they're not like, these are not just paper policies, right? Like if they say that this is the way that they calculate risk, they will really make sure that everything is done properly. And the interest here is that the central bank understands that, especially for a very large financial institution whose like health the whole economy depends on, them crashing is probably not ideal. And so ensuring that everyday practices, not just like, the top level meetings, are done properly can be quite important. They also create regulation, like I mentioned, especially like I mentioned as well, evolving nature of the financial industry makes it very prudent to have like advisory, like how do we do this? How do we react? A good example might be with artificial intelligence. On one hand, you want banks to take on like new technologies that reduce the risk, that make them make better decisions, but you also don't want a lack of transparency. So, for example, if I had a banking algorithm that used race, that used gender, to be able to determine the risk profile of a certain like group of people, um, on one hand, you can argue that is like increased information that will give you or let you make good policy decision. But like more ethically, and probably where I stand on this equation is in inputting that as a way to determine whether or not someone deserves a housing loan is pretty dangerous and can lead to different groups of people being excluded on immutable characteristics. And I would say that most countries, most like governing bodies, will express hesitation towards doing something like ignorant of its social effects, especially as a government that is still relatively accountable to its people and cares about that. It's also expanding its mandate in some places. More banks are doing climate stress testing. More banks are incorporating the environment in a lot of their financial decisions. Primarily because this is one of the greatest risks of our times, and it affects profit, it affects revenue just as much as other business inputs might. So being cognizant of it can be quite crucial. Capital markets. So a financial market where long-term debt or equity is sold. The goal here is to take the money of savers and put it to productive use. And here, this is probably the case of like companies, right? Companies that employ people, provide goods and services, and contribute to innovation. Equity. Um, it depends on the kind of equity that you hold, but a share of ownership or equity is a share of ownership over a company that allows you to, one, you can take from the earnings of the company through dividends. Importantly, the company decides this. As a shareholder, you can't just be like, pay up, give me $100 or anything like that. And companies do like to do this because not only do they make their current shareholders happy, but they can encourage future investment by telling shareholders or future shareholders that we give dividends, we're a worthwhile investment, put money into us. Second is you can earn by selling the stock at a higher price. If I bought the stock for $10, sell it for 15, then I make $5. That's nice. Third, not all, but some shareholders can vote in key company decisions. So for example, you can elect a director. You can merge with another company. So a lot of things that are kind of deemed to be fundamental decisions about the nature of the company are things that shareholders often have to vote on. It can't just be something that the CEO will do and not tell anyone. Um, Fourth, you have a right to assets of a company in the case of liquidation, but importantly, this right is lower than that of debt holders. Meaning, if this company goes under and you have to sell like the land that they own, the factories that they have, their intellectual property, uh, you can claim some of it, but you have to pay the people that the company owes money to first, and then you can have some of it. So generally, it's riskier than that because the earnings are not legally obligated. If you invest in a company and their stock price goes to zero, you can't do anything. Like that's just how it works, right? Like you have to accept that it comes with risk. You have to accept that you invested in a worthless company, unfortunately. However, it can also have a higher upside than that. And like I mentioned, risk has to have a return. Your $10 could go to zero, but it could also go to 100 if the company becomes one of the biggest companies in the world, for example. Debt is the legal right to be repaid at a certain agreed upon amount at a future time. So debt holder can make a legal claim over debt that is held. I can take this to court. You are obligated to pay me back because you took my money and you promised me that you would return it with a certain gain. So there is more legal liability with respect to debt. And in the case of liquidation, debt holders have a right above equity holders. So like I mentioned, if the company goes under, the debt holders will be prioritized if you have to sell everything. It's generally seen as safer but less profitable than holding equity for the previous things I mentioned. Um, it's also more certain in a sense because, or at least the upside is more certain because for debt, you might, for example, lend $100,000 at a 5% interest rate for 10 years. It's not hard to calculate what that is. Whereas for equity, if the company, grows 10 times, 100 times, 1,000 times, it can take on many, many different values. Lastly, debt holders often, but not always, have incentives in long-term stability compared to equity. That's not to say that equity holders don't like stability or have a long-term interest. But the difference is that they would much rather that this company just stay alive enough to be able to afford being able to pay the debt back. So they might just want the company, even if it doesn't take a big swing and multiplies its value 3 times, if it just is as it is now and pays you back the money, that's fine. Whereas a shareholder, it makes a lot of money if the company multiplies in size. So there's a different risk attitude here. Debt holders generally will prefer safety, not just for themselves, but for the company. Don't take on too much debt, don't do anything stupid. Whereas equity holders will generally want companies, at times even, to take on a lot of risk if it means that the possibility of multiplying that value is significant. So an important mechanism by which debt holders exercise control over borrowers is through covenants. I want to mention this in the lecture because I think a lot of debates I've seen have people saying equity holders can vote, but if you're a debt holder, you can't do anything. When really, prior to you providing the debt, you agree on certain covenants or certain conditions that a company must follow. Examples of that are you might have to not spend this much amount. You might not be allowed to take on this much more debt, usually in the form of ratios and numbers that make sense for the company. An important aspect as well is that companies take on debt regularly. It's not the case that they just take one big loan and then they make it big and then they're done. A lot of companies need debt, and there are a lot of benefits to debt. Namely, that you don't give up any control because it's not ownership, that you can use money that's not yours as well, and that gives you increased profitability ratios on that. But anyway, debt, because it's taken regularly, it matters how other people see you and your willingness to pay that as well. So debt holders exercise control in that sense because it ensures that you are not just what do you call this? You are giving out debt, or rather taking on debt at a frequent enough basis, and so your reputation matters because otherwise they might charge you a higher cost for that debt. They might ask you for more in exchange for that debt. So you can't just take on a big loan and then not pay it back and then expect everything will be chill. You're probably going to have to pay a lot more for your next loan because now everyone thinks you're riskier. All right, public versus private. So shares in a company can be publicly traded or privately owned, and publicly traded stocks are bought and sold at an exchange. Whereas privately owned companies buy and sell ownership in privately negotiated agreements. I think fairly intuitive, but number one, how do you do this go public thing? So you need more regular financial reporting. You have financial statements, disclosures, annual reports, and quite frankly, when you haven't done it yet, it's a huge hassle. The amount of third parties you need to contract, the legal that goes into it, the challenges of generally following all the regulation, they're not negligible. And secondly, there's more regulation, especially in corporate governance, meaning you might be required to, for example, have more independent directors. You might be required to have certain people on the board, etc. Third is there's also more auditing, So you're going to have way more eyes on your company, and not just like on the news and stuff. You might have an auditor regularly come to your company, see that all the financials are not fudged, see that everything is clean, see that everything is done well. And the logic here is you're asking like the average Joe to put money in your company, not in a privately negotiated setting where this is either a relatively large company as well, or where you have a good relationship with the people buying. You're asking everyday people to just be willing to press a button on their computer and say, I will buy this stock. You don't want that to happen. And then all of a sudden, news comes out the day after that, oh, this company has fudged all their numbers and it's actually worthless now. Um, that's the dude's like life savings, possibly. Well, hopefully not, but like down the drain. And creating that public trust requires all these transparency measures, all these accountability measures, all these governance measures, because now the government feels like there is a public mandate to be able to create trust between any investor possibly and the company in question. So why would you go public? It seems like such a hassle. And the simple answer is money. When you're traded on an exchange, that increases demand because now everyone can buy stock, right? And usually you would do it at an opportune time. It's very unlikely that you're like, oh, my company has a bad financial outlook, so it doesn't, we should IPO. Usually you would go public, IPO being initial public offering. Usually you'd go public when you're at like a point of hype or a point of excitement in the company, or at the very least you're like you feel good about your company's future prospects, because by nature the IPO process generates hype. When this company is like, oh, we're gonna IPO, the attitude of everyone is that they start to feel like, oh, this company seems to be very confident, they must know something or they must have something that is really exciting, or they have projects down the line that will make us think this is going to go up. It also makes it more worth it because, like I mentioned, people want to sell their investments. So when you're on an exchange, it's a lot easier to do that. Like one day I have it, the next day I might want to sell it. Versus if I had to privately negotiate all of these different like buying and selling terms, um, that also like increases the price because of its liquidity. So why would you want to go public? Here are just some examples, right? Maybe you're a tech company with a lot of future potential, but you need capital to scale up. Maybe you're a manufacturing company that also has a lot of potential, but you need short-term capital expenditure on infrastructure. So you gotta build factories, for example. You gotta improve your distribution like lines, for example. Maybe you're a pharmaceutical company that needs capital for R&D, for medicines that are gonna be made years down the line. And so you need that capital now so you can capitalize on it in the future. Why would you not do it? Well, one, it's a lot of increased scrutiny. And having everyone have access to your financial records can be advantageous for your competitors. It's not hard in the process of transparency that you not only let potential investors know, but also potential competitors know how you do business, your tricks, your strategies that could be good for them to adopt. A public company with a stock price can also be a lot more reactionary. So if I'm a CEO and I want to do something and I see I have a public stock price, it'll always kind of be in like the back of my mind, right? Like knowing that the whole world sees this price and that if it goes down, it looks like my company has bad prospects. And if it goes up, it looks like my company has good prospects. And so there is an increased possibility of short-termism with that kind of consciousness. It's also the cost. IPOs are not cheap, and of course you want to argue that the IPO will give you more money, and most of the time it does, but some IPOs fall through. Some IPOs don't get the return. Like for example, a company might be like, we're expecting everyone to think our stock is worth this much within a few days time, and maybe day one there's a lot of hype, but then day two, day three, they're like, okay, this is not what it was promised to be. It's not as good as I thought it was going to be. And so they take on all the expenses of an IPO and then they don't make it back. The biggest expense, or one of them, is the investment bank. when you IPO, because they have two options. One is a firm commitment, which is basically saying, I, as the investment bank, will buy the stock you are making public, and then I will sell it to other people. So that decreases risk for the company, but increases risk for the investment bank. There's also best efforts, which is like, you know what, I'll sell what I can. And so it's not assured that all those stocks will be sold. Um, that's both cases are risk and effort taken by the investment bank that in IPOing you will have to pay for. Of course, usually the IPO will be a net positive. It's just a matter of, is it what you expected? Was it worth the exchange of control? Was it worth possibly giving up, waiting for you to have had a higher stock price when you IPO'd rather than the one that you just had? And lastly, loss of control. A lot of businesses are family owned, are owned within a small group of people, and that's because that's when you have the most people you trust. Maybe it's your family business, it's been passed down generation to generation. And so having outsiders enter is not an easy thing for a lot of these companies. And control and the ability to have that control is a pretty big thing to give up. Alright, I want to talk about short selling for a bit. Because I see this in finance a lot, and I've set my fair share of short selling motions. Traditional finance tells you to buy low and sell high, so you expect a future gain. Short selling reverses the timing of that. So you sell high, and then you buy low. You expect a future decline, right? Because if you sell now, and then you buy in the future, you're expecting it to go down. So here's how it works. Borrow a stock, plus a small fee. You sell the stock for a price A, then you buy the stock for a price B. And you make money if A is greater than B. There is a fee, it's usually small enough. Not negligible for sure, but I don't think it really matters in a lot of debates. Why do we allow short selling? Well, number one, you can argue some downward pressure on stocks may be good, right? Most of the market wants stock price to go up, and this drives what information can come out. So if I own this stock, of course I want the stock price to go up. If I'm a company and this is my stock, of course I want it to go up because it looks like I'm doing better as a company. And what that does is you can argue the existing values that are on the stock market right now are not reflective of their true value because the incentives, or for example, what information comes out, different analyses that come out, are not necessarily reflective. And that's good because it can prevent bubbles. A bubble happens when the market value of a stock far exceeds its actual value. And when people start to realize that it's a bit too high, it crashes. And by preventing that crash to begin with, you make sure that people are not buying at the very top of that price and then having it go down. And then, like we mentioned, the impacts, right? This could be a pension fund whose retirements people, whose people's retirements of people are held. It also ensures that generally there are less huge risks that firms are taking on because they're not investing in what seems to be a very fast-growing stock, but instead crashes almost instantly. You can also argue negative information is good. A lot of what short sellers do is they'll they will buy the stock, or rather they will sell the stock at a high price, and then they will release a report or some kind of financial information that is reflective of the company's bad practices, whether it be labor practices, financial mismanagement, etc. And that might be good because you want market watchdogs. You want people to look at the market and think this isn't all sunshine and roses, that these are things that need people to check the legality, ethics, and other things about the company. You also allocate capital to where it may be more productive. So an argument you can make for short selling is that there are just some companies that unfortunately should probably decline because they're not built for the modern time, because they don't have a good business model anymore. And if the goal of the financial market is to ensure that money goes to productive uses, then putting downward pressure on a stock might ensure we're moving money away from that stock and then putting it towards maybe other companies that have a much bigger potential for hiring people, much bigger potential for providing a sustainable product or good or service. Why can short selling be dangerous? Number one is there is possibly unlimited risk. I want you to look at two situations. Let's say you buy then sell. Let's say you have a stock price at $10 and you bought it. Worst case, that stock becomes absolutely worthless. Your loss is zero. Or rather, your loss at $0 is $10. So the loss here is capped at how much you bought it for. Whereas if you sell then buy, losses are theoretically infinite. Not to say that they are infinite, but they are definitely uncapped. So if I sold at $10 and then I don't realize that I'm very, very wrong about this stock going down and it goes to $200. I sold for 10, so that's plus 10, but then I have to buy for 200, that's minus 200. That's a loss of $190. And that's the difficult thing with short selling. It's very difficult to estimate losses when they're theoretically infinite. Second, this can encourage short-term negative information because a lot of short sellers are not going to short sell like years down the line. They might just buy, or rather sell the stock now and then buy it back in like 3 days, 4 days. And so this might encourage information that is negative about the company, but is also not something so fundamental about the company. It's not that big a problem. And instead might induce panic, might induce hesitations about the company that will make it perform worse because now they have less, investment or less possibilities for investment. But are also not actively calling them out for a business problem that is so difficult to solve. Third, upward financial environments actually might be better for everyone, right? Positive business outlooks encourage investment. So putting downward pressure can make people afraid of putting their money in the markets, and that can have close up lines of investment for people. And you can argue, right? It's not that everyone wants stock price to go up all the time. There's enough downward pressure from regular buying and selling. Like if I am looking to buy a stock, and I think it is currently overpriced, I might put out the negative information and then buy it for a more accurate price. Or my act of selling a stock might signal to other people that this stock is not, worth it or as worth it as it is now, and might encourage other people to sell the stock as well. So it isn't necessarily the case that the market is all upwards looking. There is sufficient downward pressure, and creating a new mechanism for downward pressure, especially when it can run into a different host of problems, it has its own issues. I'm going to take a break. I'll be back. All right, I returned. I want to now talk about the private side of capital markets. So private equity and debt are a broad class of investments in the equity/debt of private firms, usually to a private equity or debt fund or as a merger or acquisition with a different firm. I'll get more into detail about the structure here later, but I will say before I begin the rest of this that I will mostly be talking about private equity, primarily because I think that's where most debates revolve, and that's where I do think most debates probably are deeper. So there are two reasons for private investments. Number one, and very obviously, for profit. You invest in something because you think it'll make you money. The second is strategy. So investments are made in relation to the other investments held by the firm or for the firm itself. So for example, if I am an investment fund with a lot of restaurant chains, if I buy a fresh produce company, I'm not just buying it because I think the fresh produce company can make money. I'm buying it because now I can sell, or rather give the produce of the fresh produce company and sell it at a cheaper price than I would everywhere else on the market to my restaurant companies, because restaurants need produce, right? They need ingredients. And that is an example of a synergy. You have a productivity and search engine company buying an AI firm. It's not just the fact that they think the AI firm will make money, But now you have a ton of data from search engines and also integration, right? So if Google buys an AI company for Gemini, right, they can use to integrate into Google Slides, Google Docs, then that has its own synergistic effect that would not have otherwise existed. So private equity and debt funds have different mandates that differ in number one, timeline within the business life cycle. So companies are not like monolithic, right? Some of them are fairly small, have proof of concept, but at the same time, they're probably burning cash. They're probably not profitable yet, and they're probably not a sure thing. And then they grow a bit, and they start to become more stable. Maybe they're break even, not yet profitable, but they've also been a couple of years in the business, and you have some certainty that the management team is pretty good, some certainty that they have customers, like actual customers that use their product. And then there are older companies, years in the industry, profitable most years, maybe there's some down years, but then there's some maturity. And then you have late stage companies, either companies that are just well established industry for years, or maybe they're not doing so hot anymore. So there are different timelines here. So those different timelines imply different risk profiles as well. So there's a relationship between the first two. Because when you're very early in the timeline, I would say there's definitely quite a bit more risk because you don't know whether or not they're going to grow to a significant degree. You don't know whether they'll be profitable even. Whereas a later stage company might be. And then there's also just investing in a later stage company that might be already distressed. Like maybe they have not been making money for the last 10 years and then you buy them. Again, risk has return. And so with the funding that you provide these companies, you're probably getting a lot more control, and you expect that the amount of investment for that control is not going to be a lot. Right? They're not going to charge you so much for it. At the same time, it's not just the profile of these companies, but what your strategy with them is. Because I think a common misconception is that people think that you're just going to buy these companies and that's it. Obviously, you want to sell these companies at some point. Some of them might buy them and hold them for a long time. That's definitely possible. But I would say the overwhelming majority of private equity wants to sell them, either through an IPO or to a bigger player. And just to show you the difference in strategy, given the same timeline and risk profile, let's say you have a distressed company, like they have been losing money for the last 10 years, but they were, a giant for 40 years. One firm might have a different strategy in that they will take the company and attempt to turn it around. Say, you know what, this is still salvageable, this is still a profitable business model, let's work with it. Another firm might look at it and say, let's cut it up, let's sell it for parts, and try to get the best price out of it. And that also takes its own expertise. So there are different strategies here. Lastly is industry. Yes, it's important to have like diversified investments for sure, but it also helps to have domain knowledge. So when I am a firm that invests primarily in, let's say, tech companies, if I have a lot of experience in the space, I have a lot of engineers that have turned into finance people on my team, then it's easy for them to snuff out like, is this just a startup that is, everyone sounds good, everyone sounds like nice and convincing, but does it have actual meaning behind its product? Similarly, you don't just want to be able to determine whether or not investments are good, but you also want to be able to provide expertise when you have control of the company. So going back to the restaurant example, if I have years within the restaurant business, maybe this is a family company that I'm investing in now that didn't know. Here are some optimal ways to set up your restaurant so that servers are cutting the amount of time they need from the kitchen to the table, that people are not bumping into each other in certain like parts of the restaurant. Things like that provide a lot of expertise. And going back to the relationships, this is what it looks like. You have some investors put their money in a private fund. Those private funds determine should we give debt or equity to like all these different companies. And then within these individual transactions, the returns go back to the private fund, and then the private fund will return some of those returns to their investors. So everything can really be summarized into a diagram like this, to be honest. Some are more complex than others, like here, there are a bunch of companies, but that's really how it is. It's difficult to say private equity and assume the same things happen. Private equity is a very broad range of things. Like I mentioned, all of them have different mandates, different strategies, all that. But the common playbook is you take a company with potential, but also some proof of profitability. You acquire the company, usually through a mix of investor funds and borrowing. So you're not just going to spend your own money, you will borrow money to acquire it, mostly because it allows you to do more things. Meaning, if I have $1 million and companies costs like $500,000, I could like invest in 2 companies, or I could have like a $250,000 investment and then take on $250,000 of debt and then invest in 4 companies. There are also some math stuff with like how that affects your profitability ratios. Generally, using leverage can increase the profit margins, but that's the general logic there. After you acquire the company, you make it grow, you increase revenue, and you cut expenses, and then you exit. Either you sell to a different investor or you IPO. You go public. Arguments around private equity. First thing is you can say this contributes a lot to operational efficiency, right? When you have people who are experts and know exactly how to run a certain type of company, there are a lot of things that the company might not have been aware of that are now. Take, for example, hotels. Like, hotels look very the same, especially if you go to the same branch. And so when private equity takes over a certain hotel chain, they're very good at standardizing it, making sure it's efficient. So making sure people are in their rooms, that you're charging like optimal prices, that the booking never gets messed up, etc. And the social good that this can create is you can pass on the savings to customers, or you can offer a better product to customers, can be used for R&D, can be used to expand and hire more people. There's also synergy, right? Because now, like I mentioned, you're in a portfolio of investments, or you're now part of a bigger company that needed you, and they interact in mutually beneficial ways. Last thing is financial health. So they encourage frugal spending while also providing the capital needed for growth. So not all the companies have the former, and private equity gives access to the latter. Meaning, a lot of companies end up having a lot of bloat. They spend on things that are not super necessary, and they don't realize it. Because like I mentioned, a lot of them are good at their particular industry, but maybe not as good at expense management, for example. And private equity also gives you access to the latter, meaning if you want to be able to get capital to be able to grow, then private equity gives you access to that capital. Downsides. Definitely there is some short-termism. Unlike a shareholder, like a regular shareholder, who has a long-term stake in the company, private equity there's definitely a propensity to like build up your value and then sell you, which might lead to ruining relationships with customers in the long term, ruining reputations in the long term, making changes that are not sustainable, for example. There's also, operational efficiency. The bloat I mentioned, on one hand, it could be genuine bloat, like availing of services, having suppliers that are charging you so much, or not having optimized like ways to be able to like manage business. So like I mentioned, a lot of restaurants and stuff are just not constructed ideally and create a lot of operational like mess, operational delay. But, and very, I think, realistically, there is a lot of this operational efficiency stuff that is just we have too many workers, we should transfer work to the most like productive people and cut wages, lower wages, cut workers. It's a very real impact of private equity, and I think one of the most negative aspects of being owned by private equity. There's also this idea of over leveraging. So, like I mentioned, you take on debt to acquire companies. This leads to short term financial pressures because they need to pay that debt back, and possibly unhealthy debt for private equity funds, right? So, it might sound good if your investments are doing well, but if your investments stop doing well and you took on debt to acquire those investments, maybe not the most ideal situation for the funders of many different companies to be in. All right, fintech. So it's a growing industry that provides a lot of financial services. So these are digital banks, payment systems. So like I mentioned, like PayPal, Venmo. In the Philippines, you have GCash, Bcash, for example. Lending, insurance, investment. Essentially, things that traditional banks do that are now being moved towards apps, websites, new technologies that would not have been available before. So what makes fintech different? Number one is the target demographic. So a lot of fintech firms aim for greater inclusion and access. And obviously there is like an altruistic motive to that to some extent, but there's also a what do you call interested motive for that to an extent as well. Which is that this is the group of people that was previously underrepresented within the traditional financial system. And so if you're going to compete, if I was to choose where to save my money, right? The very safe big bank or the very new, unestablished technology, I'm probably picking the big bank. And so you would probably have to cater to the people who did not have the same choice. And the reason traditional finance can be quite exclusionary for a lot of people, things like strict documentation that is inaccessible. So whether it be not wanting any kind of criminal record, not or just even having an ID is a pretty big barrier to access for a lot of people. Income and wealth requirements. So a lot of them maybe will let you set up an account, but maybe won't give you a loan because you need to have proof of income. And there's also a lack of access to the physical financial establishments. So if I'm a bank and I'm thinking, where do I put up my branches? I'm probably doing it in metropolitan areas that have a lot of people and I can make a lot of money, there are a lot of transactions. Less so interested in rural areas that are sparsely populated and don't have a lot of people. So the trade-off here is that they cater to, I would argue, a fairly large base in a lot of developing countries, but also that this base can be very risky because when you have less documentation, the possibility of fraud is larger. When there's less income and wealth declared, then you're less likely to get paid back on a lot of loans. The use of technology. This is, the main reason that they can cater to this demographic, because this new technology allows you to have, well, number one, a better understanding of individual risk profiles. So if I am tracking your smartphone actions, your payment history, and feed it into advanced algorithms that determine creditworthiness, that's more information I can use to say, you know what, I can actually extend you a loan. Versus, if I just got your documentation, which is, by description of the previous slide, more likely to be lacking, it is very difficult to extend that same loan. Second, it's also increased access because the technologies involved become more accessible. More and more people have a smartphone and an internet, and that's actually become a lot easier to obtain than just have a bank in your city if you are very far from a city center. Third is you can cut costs because you don't need a physical bank or a physical location. And so it also decreases the number of employees that you need, decreases the need to be present everywhere all the time. However, that increases the risk because now the likelihood of fraud, default, and more are just much higher. Third is daily integration. So what a lot of fintech firms want to do is they want to be used on a regular basis. So when you go into a store, they want them to be the mode of payment. When you pay your friends back, you want it to be on Venmo as a way of amortizing your groceries, so your expenses now have a buy now, pay later option. So given the riskier base with less capital, volume is often the name of the game for a lot of fintech firms. you know, if you're making small margins on every individual person, and that's assuming you're making small margins, it helps if you're doing it for a lot of people. They also tend to be much smaller ticket just to avoid risk. So if you're a riskier base with less capital, you're probably not going to get a housing loan through a fintech like startup. That's a lot of money that they might lose, and it might not be super worth it for them. It's also usually not the case that large loans are handed out or that big corporations are putting all of their money on a digital bank. I think my dog is in trouble. I will take another break. Okay, my dog just wanted to see my other dog, Drama Queen. Um, anyway, the small ticket generally, as a summary, because there is increased risk with the concentration within large capital like investments. So if you give out like a house or a car, that is maybe a bit too much for a fintech firm to be able to swallow. Notes on fintech debates. First thing, access is not always ethical access. So, yeah, it's one thing to make funding available. It's another thing to make sure that getting the interest back on that funding, for example, is ethical. So you have to make sure interest rates are not predatory and that the practices are humane and legal. It's this constant balance of you have to understand that you do probably have to profit as a company and be sustainable as a company. And that if you are, in some sense, too lenient with a high risk profile demographic, you can very easily find yourself like running out of business. And at the same time, not squeezing people in a tough situation out of like every dollar they possibly own. Second is they must be compared to informal financial institutions. So for the previous reasons I provide, um, a lot of the time these people are locked out of traditional finance. So they're not like short on groceries and then going to the bank to get a loan. A lot of the time, they're gonna have to take loans from loan sharks, payday lenders. They're gonna have to take loans from their friends or their family, and you have to ask yourself, are are, are these good alternatives to the existing informal financial system? And importantly, what kinds of informal financial systems are they exposed to? Because imperfect, but lending from friends and family is probably better than lending from known predatory like institutions. And so you have to look at what are people exposed to, what are you willing to weigh and trade off, and how do you compare that to fintech. Lastly, traditional financial institutions act a lot like fintech. So it's not the case that traditional finance was like, oh, we've carved out our space. Here is the space that you guys can operate in. A lot of the time, they see this as, oh, they're cutting into our profits. They're cutting into our industry. And so we have to do the same and we have to compete to some level. And so it's not this clear line of like traditional finance and fintech. Often it is traditional finance and fintech with a lot of intersections with respect to companies and company practices. So banks are becoming more digitized and trying to craft a place for themselves without taking on excessive risk. And that's where I think fintech can really play. Because I think banks are up to way more regulation and are required to be much healthier than a fintech firm. And because of that, they are still limited in their ability to play in this space, alongside just general attitudes and cultures within a bank that might say, we don't want to take on too much risk, right? That allow fintech to enter. But at the same time, there's argument to say that the way that fintech operates pushes banks to act and adopt practices in certain ways as well. Derivatives. I don't want to spend too much time on this, but they're a broad class of financial instruments whose value is derived from an underlying asset, instrument, or variable. I have seen some derivatives motions, but not a lot. I will get a bit technical because I think that's what is required. So here are just some examples of some of the most basic derivatives. A future, similar to a forward, is an agreement to purchase a good at a future time at a predetermined price. For example, I will buy gold from you in 3 months at X number of dollars. And the big thing there is that if I just waited 3 months, then you wouldn't be cool with that. You would tell me to buy gold at the price that it is being sold for in the market today. Whereas beforehand, regardless of what happens in the next 3 months, I am assured that I can buy it for that price. Obviously, we'd both have to agree on it, but the big thing is that I can lock in the price now. An option is similar but different to a future, where you do have the right at a future time to buy or sell something, but it is a right and not an obligation. Because in a future, the exchange has to happen. I have to be able to buy it from you, and you have to sell it to me. Whereas for an option, I can choose to buy it or sell it. I'll give a much more illustrated example later, but that's why for an future, you are going to pay the price that you agree on. For an option, you pay the price of a contract, which is essentially pay for the right to choose at that time. For a swap, you exchange two cash flows with different conditions. So for example, I might exchange, I don't know, some of them will be currency exchanges, for example. I will swap this cash flow of US dollar, and then you have to give me Japanese yen in exchange. And that makes sense for maybe a US company and a Japanese company that maybe are operating in the same country, and therefore would be beneficial for them to transact directly. Derivatives are a huge class of financial instruments. Like, it's very hard for me, I think, to debate them and think that they're kind of all the same. They can be very simple to very complex because the terms can determine the derivative. So for example, there is what's known as a chooser option, which is you don't just have the option to buy or to stud. Like let's say a call option is the option to buy something at a future time. A put option is the option to sell something at a future time. So in a call option, in 3 months, let's say it's at a good price, I might say, okay, I'll buy it now. A put option, in 3 months, I might be able to sell it now at that price, and the person is obligated to buy it. The important thing is that when you hold the option, you have the right to choose. The person who sold the option to you has the obligation to just follow whatever you choose. Like, if it's a call option, they have to give you the product. If it's a put option, they have to buy the product from you. A chooser option is an option that allows you to not only choose whether to buy or to sell, but you also get to choose whether it is a call or a put. So it's not just I can choose to buy or not to buy, it's that I can choose to buy this from you or I can choose to sell it to you, depending on what's more advantageous to me. And of course, with the two choices there, it's probably going to be a bit more costly. It also depends on the underlying. So yeah, you can have options on things like stocks. You can have an option on many different financial instruments. But you can also have derivatives on things like the weather. That might seem nonsensical, but if I am a company who is heavily exposed to the weather, a derivative might be important for me. So there are three types of people who deal in derivatives. Number one is arbitragers. Are people who seek to make a riskless profit based on market mismatches in prices. That's usually not that important for debating. But long story short, if the price of something is $10 in one market and then $11 in another market, I can instantly buy the $10, sell the 11, and then make $1, right? I don't think that's that useful for debating. But the important part here is that it's riskless for an arbitrager. A hedger is someone who uses derivatives to hedge the risk. I'll show you an example later. But if I have to buy a large number of agricultural products, you can buy options on that product. There are also speculators, people who seek to profit off derivatives transactions. And importantly, these are not riskless. They are based off market expectations. So it's not like the arbitrager who can instantly do it. It's someone who thinks the price of this will go up or down, and therefore I will buy or sell a derivative based on that. Important note, many people involved in derivatives trading don't need to take part in the physical delivery of goods. So if I'm selling corn futures, it's not necessarily the case that I have to have like a warehouse full of corn. It is either the case that the contract is specifically cash settled. So I'm saying, yo, we are agreeing just to exchange the value of these things, not the actual things. And there was never an expectation of physical delivery to begin with in those cases. Or you sell the contract to someone who can actually deliver. So you enter, it's called an offsetting trade. It's kind of like you do the opposite side of it, so you're not really exposed to it anymore. And that's how you exit the contract. Sample situation. Options on corn. I am a company that uses corn as an input for my business, and I need to buy a bunch of corn in 3 months. And I stay profitable if corn is less than $5 per bushel. Let's say I buy options that give me the right to buy corn at $4 per bushel in 3 months. Buying the option, however, has a cost, maybe 10 cents. There are 2 scenarios. Obviously, it can be a bunch of different scenarios, but just for illustration, there are 2 scenarios. 1, corn drops to $3 per bushel. So my contract says I can buy it for $4. But right now it's at $3. So why would I choose to buy it at $4 when I can just buy it at $3? So I won't exercise the contract. I am going to stay profitable as a company. Unfortunately, I waste 10 cents for the contract, but it's still less than the $5 that would have made me not profitable. Let's say there's scenario B. Corn goes up to $6 per bushel in 3 months. Here is where my contract comes in handy. I will exercise the contract and buy at $4 instead. And that ensures that I don't have to pay the additional $2 of the price now. And that has allowed me to manage my risk, because the 10 cents that I paid for this contract is less than the $2 that I would have had to otherwise pay if I just waited for the price of corn to go up and then bought in 3 months. So isn't that an amazing thing? Yeah, sure, but this assumes all derivatives users, number 1, make smart hedging decisions, and number 2, only really hedge. For speculators, buying the corn wasn't inevitable. They made a bet on the future price of corn and wanted to profit off it. So it isn't always the case that's used to manage risk. In fact, you take on risk for speculators. Additionally, many hedgers can lose significant amounts of money. The previously wasted 10 cents, that can become a lot if you buy millions of these contracts. So it's not just like, oh, 10 cents sucks, but options, for example, have a cost. So is it the case that speculators are the problem, right? If hedging is good and then speculating is not necessarily good, then these speculators are evil and they're making all the risks in the industry. That's not necessarily the case either. The market would shrink significantly if you only had hedgers, and this makes the market less liquid. By having more participants in the market generally, you have less people, or you have more people buying and selling, and therefore it becomes easier to engage in these transactions. So having a lot of speculators helps keep the market going. And you could also see this as a healthy transfer of risk, right? People who don't want risk are giving it to the people who are willing to take it on. And to some extent, maybe that's a good thing, because they probably are not just willing to take this risk for no reason. They probably either have good intuition about whether or not the stock, or rather the underlying, will go up or down, or they just have the appetite to take on this risk. Can't you hedge in other ways? Well, 1, time matters. So I can't just wait. I can't buy the agricultural product now, because then it would expire in 3 months and it would not be worth anything at all. Second, some of the underlying variables in derivatives aren't tradable. Otherwise, such a derivative based on, they're not tradable otherwise. So for example, if you have a derivative that's based on the weather, and that's real by the way, you have a derivative based on the inflation rate. I can't find something in the market that will let me hedge my risk in the same way, as explicitly and as clearly as just basing a financial instrument on these variables. Thirdly, it allows you to transform risks that are mutually beneficial for both sides. So for example, if my company is based in the US and I have another company that's based in Japan, exchanging, currencies, an exchange rate swap or a currency swap might be beneficial for both sides. You might also have a fixed or floating swap, which is one side will pay a fixed rate of interest and another side will pay a floating rate of interest. And maybe they want to change the types of risks they're willing to take on by engaging in these fixed or floating swaps. So don't they just reduce everyone's risks then and give it to those who can take them? So generally derivatives are a good thing, right? Well, big question of whether or not derivatives markets increase or decrease risk in the whole system. So an important aspect of derivatives is the possibility of contagion. One, you have speculators who, like I mentioned, like these people would not have had to buy the coin. But now they are increasing their risk exposure to the price of coin. And if they do that smart, it's probably fine. But if they don't do it smart and they start gambling, start playing it risky, then it's not so fine. Second, the failure of a counterparty to pay can create a domino effect. So these are transactions with two sides to them. If one of them, for example, says, oh, I can't afford to pay you my side of the derivative, then if I was relying on that amount to stay financially healthy, then I might fail to pay my side of my derivatives in other cases. And that can create a domino effect that can be quite dangerous for the whole system. Thirdly, leverage amplifies the magnitude of both gains and losses. So if you think about the coin example, if I am buying options on corn, without derivatives, I would have had to buy the corn, right? And so if corn was at $4 per bushel, let's say I had $4 exactly, I would only be able to buy one bushel. And so my exposure to that price of the bushel is not the biggest. But with the same $4, I could have bought 40 options on corn. And what that does is for the same variable, which is the price of corn, buying 40 contracts on that one variable can significantly change the value of my option. Whereas the small price changes with just one bushel of corn would not have been nearly as impactful. And a lot of the time, when derivatives traders engage in these transactions, they borrow money. And so if I'm borrowing money to engage in this transaction, I can increase the amount of money that is exposed to this. And also the very cut up nature of it means that small variable changes can have large impacts on a portfolio or the amount that I borrowed. This can be very, very risky behavior because it means that small changes in variables like price, interest rate, etc. can have massive impacts on a portfolio. This can increase risk significantly. So that's the question now, can't we just regulate derivatives? One, they're pretty complicated, and it's difficult to not just know we should regulate them, but also how to regulate them. This will cause a lot of discussions in the respective legislative bodies of any country and very complicated discussions. And imagine, right, it's very hard for a politician to campaign on, I think it's prudent for us to regulate financial derivatives. Not really the, most compelling campaign slogan in the world. Secondly, there are just so many of them and they continue to evolve. You started with these more vanilla derivatives, and then you get into collateralized debt obligations. Then you get into CDO squareds, which are collateralized debt obligations on collateralized debt obligations. And it becomes difficult to catch up, regulation-wise. The complexity makes it difficult to understand and put in the proper regulations in place. And the evolution makes it so fast-paced that it becomes difficult also time-wise to catch up. Third, it isn't always easy to differentiate hedging and speculation behavior. So it might sound like hedging makes sense, speculation is risky, we should encourage one and discourage the other. But how do you know that just because they're an agricultural company or they use something as an input for their business, that they're actually not speculating? In fact, there are times where it's even difficult to differentiate speculation from arbitrage. There have been companies in the past that have crashed because they were convincing everyone that their speculation behavior was arbitrage. It was not as riskless as they thought, and they ended up going under. Lastly, as mentioned before, regulation can be pro-cyclical instead of anti-cyclical. easy to regulate derivatives when a crash has just happened. Hard to do it when the derivatives market is booming, it's giving everyone liquidity, everyone's using it, it seems to be like the hot thing on the market. I will end this lecture on real assets. So real assets are physical, tangible assets that are useful for their physical properties. And their value is given by, number one, the intrinsic value from the benefit of their use. And I think you can see this most clearly in real assets. A house will be lived in. Gold is not just useful because it's like an investment, but people like to wear gold. People like to use gold in, for example, technological purposes because it's a conductor. And there's also the perceived value of the asset. Houses are valuable because people see them as an investment. Gold is valuable because people see it as an investment. And so, you have to note both of their sources of value, real assets. In debating, probably the most useful form to know are properties and housing. So, by nature, there are a lot of housing cost rise, escalating housing costs motions, because it's just true almost everywhere in the world, or at least in most cities throughout the world. Primarily because of population pressures. Populations grow, but also they are growing in cities. So even if the population of the country is not growing, people from rural areas are moving to city centers. People who would migrate from other countries move to city centers. And so there are population pressures that push up the cost of housing. Second, there's a natural scarcity. You can build more houses, but you can't build more land. And so in city centers especially, where land is one of the bigger bottlenecks for the construction of housing, it's quite tricky. Third is it's hard to construct houses, right? It's a big risk for any company to be like, we'll put up a house here, because if construction gets stalled, if people don't want to buy the house, if they can't find renters, it's not going to be a worthwhile financial investment. And so, and lastly, there's investment potential. People buy houses even if they don't intend to use them because they see it as an investment. People will buy a rest house, for example, because they see it as an investment. And so all these push housing prices up. Another important thing to note is that only a relatively small percentage of housing is corporate owned in status quo. So it's very interesting because on one hand, at least you can argue that this is not a purely investment vehicle and that the everyday person is still the primary renter or primary homeowner. On the other hand, you can argue that some people are becoming landlords on a personal level, maybe not on a corporate level. And there's a question of whether or not that's a bad thing. Or some companies, or construction companies especially, want more assurance that if they construct, they will get something in return. And so transferring ownership to a company might give them a lot more confidence than transferring ownership to just one or two people. What are some of the advantages of real assets? One is it can be a diversifying instrument. It can have a lower or even negative correlation to other financial instruments or variables. And what I mean that they have uncorrelated returns, some big companies are really investing in things like timberland, forests essentially. These kinds of land that are really just not going to be very heavily correlated with the stock market, such that they can increase the value of their investment. But in a bad year, their investment won't crash. Second is they have value tied to their use rather than to a contractual obligation, which in some sense is also safer, right? The stock of a company can go down and can become worthless, but people are probably always going to need a house. So that's why, in some sense, it gives companies more assurance. It's also an inflation hedge, because when inflation goes up, the money that you earn from, for example, if you own a house and you rent it out, rent can go up in relation to inflation. So it ensures that the money you get is growing at the very least at the same rate as inflation, if not higher. Disadvantages to it are they carry their own costs and hassles. So if you are a homeowner and you're renting it out, you are still answerable to a lot of different costs, maintenance. If you own a factory and you're renting it out to a company, you probably need it insured in case of a fire or a big accident. You probably need security on a big farmland, especially if you're not going to use it and it's not visited, the risk of trespassers is like pretty high. You also risk deterioration and depreciation as much as appreciation. So this depends heavily on the asset, right? Land by nature will probably appreciate. A car will very heavily depreciate. The moment that thing exits, like the lot, that has gone down in value. Third is it tends to be quite illiquid, meaning it's difficult to sell. So it's not hard to buy and sell a stock, right? It's pretty hard to buy and sell a house. You'll probably need a broker. You're going to spend a lot of time looking for a buyer, and you're going to have to come to a price that is mutually agreeable. Not the easiest thing in the world. So, in a lot of housing motions, there are, I think, there's always a solution. You can build more houses, right? There are some challenges to that in status quo that make it difficult for it to always be feasible in the debate. Number one is NIMBYism, which is like not in my backyard. People don't like it when you build around their existing property because, well, primarily number one, they fear that their property will lose value. So by increasing the supply of housing, and by nature, right, the goal of that in a housing motion is to make housing more affordable. If you're increasing the supply of houses in an area where one of the determinants of house value is location, you might, in exchange, decrease the value of houses in the area that already exist. And therefore, the people who are there, are present, are voting in like local government council, voting in homeowners associations, will probably oppose construction to maintain property value. It's also just inconvenient. Like people aren't going to welcome construction, loud noises, closed roads, etc. There are also just a lot of challenges like zoning laws, and whether or not you would allow mixed use zones. So zones that are used for both residential and commercial purposes, for example. There are also environmental concerns. A lot of people, and that's very valid, right? Like construction is not a costless, no negative externality activity. Second, financing. So you need financing on both sides. You need to be able to provide financing for people willing to buy homes, and you also need financing for construction companies because creating a home is very expensive. And you need to be able to successfully manage both sides of this equation and ensure there's enough credit. So in a period of high credit or high interest rates, this can be a bit challenging. Density. Density is also a big problem because you can make homes, but if they cater to single families rather than being multifamily like apartments, rather than being entire condominiums, or at least being like duplexes, for example, it becomes very difficult to take your scarce resource of land and not efficiently allocate it to as many people as possible. So a lot of housing debates, I think, like for example, putting a cap on housing prices. On one hand, you can argue it makes housing more affordable just by nature of like having housing prices. On the other hand, there's a big question of the long-term sustainability of it because you might discourage the creation of new housing if the profits you can extract from them are not as large. And therefore, it could be a band-aid solution and could cost the state a lot if they are subsidizing the potential losses that exist here. That's the end of the lecture. It's actually longer than the long time I expected to take, but I hope this is helpful. And more than anything, like the last half of it was on the specifics. I hope the first half of it, you can see the interactions and understand that the fundamentals of finance really affect every single finance motion. Thank you so much, and good luck at UADC.